Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Rahul Chadha, Chief Investment Officer at Mireg Asset Global Investment. Rahul, thank you for joining us from New York. It's evening there, I know. My first question to you is that we just got over with the earnings season for FY23. What are the big takeaways that you have, and how do you see FY24 panning out?
Okay. So clearly, if we see coming out of the earnings seasons we had, financial stood out. Financial stood out in terms of the strong advances growth, the record names they were showing, and consequently the strong NI growth. What also helped the sector was low provisions, as a result of which one saw record profits. So clearly, put financials on one side. We saw robust order book, strong momentum by industrials also. So some of these construction companies came up with good set of numbers, strong growth in order books. So that was hugely encouraging. Where things were a bit slow and disappointing was what happened on the consumer front, where the recovery is still slow. There is a bit of an softness in the space. One saw a weak set of numbers from the IT services companies.
How do you look at auto as a segment? We saw good, good coming in from there, led by Tata Motors. Do you see the kind of performance that we just saw in FY23 to continue in FY24 for that sector?
So I think what happens to auto sector is, look, we've discussed this and we've liked the space for a last couple of years. The consumers have not really upgraded the vehicles for a long period of time. There's a fair bit of new features, the infotainment systems which are coming in these vehicles. The EVs are gaining traction. So there is a latent demand for it. I think with the softness one saw in the economy, things got a bit soft. But these auto companies would get the benefit of the falling RM prices. I think some of it gets given back to the consumer in forms of promotions, and the volume growth should come back. So we are fairly hopeful of the sector for the coming 2 to 3 years.
How do you play the commodities sector here? Metals have been laggard in last few quarters. Prices coming down there. Do you see metals continue the way it is? And the user industry, on the other hand, do you expect while the top line may not grow much, there is a margin expansion that can happen in that for the user industry?
Okay. So we would play the users of commodities here. The commodity producers will go through challenging period, and I think that challenging period would be nearly next 4 to 6 quarters. Look, China was close to 50 to 60% of demand for most commodities, and as we see the economy slowing down and some of these residential starts also coming down, undoubtedly demand for iron ore, steel, aluminum is going to be impacted. So this is the time to play the users, and I think that's where we're going to see significant tailwinds come through in terms of lower RM costs for these companies, a part of which would obviously get passed on to the end consumer. But what it means is that helps in rekindling the demand.
You spoke about China. We can. What's your take on the current, slowdown that we are seeing in China? Is it going to sustain for next couple of quarters, or there is going to be a bounce back from a regional point of view? Because since you look at region very closely, how do you see China playing out?
Okay, so I think it's been slightly disappointing that the recovery fizzled out so quickly post reopening. One was looking at the huge amount of consumer savings and hoped that that would get spent, but somewhere there is lack of confidence in the economy. The businesses are not investing; they are happy to invest outside, where the clients want them to invest from a nearshoring, reshoring perspective, and the consumer confidence also is low. So we saw real estate market again show very tepid, very poor volumes in recent months, and the consumer demand has been also fairly patchy. So it would require a huge amount of effort from the government in China to get the economy back on track and momentum back in there.
Do you see China coming back to the party soon?
See, historically, if we look at what's happened in the past, and there have been precedences in form of what happened in Japan. Look, apart from stock price correction, which has already happened in China, and stocks look very cheap, what you also need is a time correction to digest the excesses. So our view is look, it would take a couple of years before the economy comes back on a strong growth momentum.
Which basically means you're looking at commodities also, on a slow burn for the next couple of years since till China comes back fully, right?
Absolutely. See, look, India is small in terms of a commodity demand, but look, if you have large scale spends happen in US or Europe, which look unlikely, that can be a boost for commodities. But for next couple of years, highly likely that commodities go through this pain of slower Chinese demand.
How do you see fund flows going through, especially coming to India or emerging other emerging markets, given the fact that China slowdown is going to, shift some kind of funds into these markets?
Okay, so if you just rewind and see what's happened this year, early this year we saw Taiwan do well. There was a huge bit of interest in Korea, and that came from strong global growth. And then was the China reopening, which obviously got attention. As questions have been asked, or as we've seen a weak momentum in China reopening, flows have come back to India, where people realize that, look, the slowdown is a temporary slowdown. It's going to be probably tough for a couple of quarters, but then the structural growth drivers are intact. From an EM perspective, India stands out as a good structural story. What works against India is the valuations are fairly expensive compared to the rest of the world. And overall, from our EMs, I think US rates at 4.5% are a significant negative. So real acceleration for the EM story comes when Fed starts cutting rates sometime next year.
How do you see that rate cycle for India, in the sense, from an Indian macro point of view, the economies are penciling in a pause and maybe a reversal by the end of the year. How do you see the Indian rate cycle panning out, and hence the growth drivers for various sectors?
I think pause is a highly likely thing in the next week. And if you're right in our assessment of China, it's highly likely that there is a goods deflation which emerges out of higher Chinese exports, basically, and which takes care of the inflation part in India. Unlike US, India doesn't have a service inflation issue. If you look at the unemployment levels, those are fairly high. So I think EMs like India should do much better on inflation compared to developed peers like US.
Rahul, how do you see FY24 panning out? We saw you gave us an initial assessment of how various sectors did in FY23. Going into FY24, do you see the same sectors outperforming the market, or do you see some recovery in other consumer sector as well, going maybe second half of the year?
Okay, so what happens is, look, the economy is on a fine momentum, good track. You see that in the GST collections also. What markets are also going to watch, apart from the economic momentum, is what happens on the state elections. If the verdict on state elections is not in favor of the ruling party, that's what's going to get market. Right? We've got a big event next year in terms of national elections. So once some of these big events are behind us, that's where we're going to see meaningful re-rating. Else, people are just going to be on a watch and wait and watch mode, etc. From an earnings perspective, we continue to believe that sectors like financial industries would do well. We've seen strong momentum come through in real estate, so that's going to happen. Because though the IT slowdown is happening, but some of these global delivery centers are more than compensating for that slowdown. What also happens over next 3 to 4 quarters is we would see revival in consumption. See, the consumption sector has taken a breather for last 4 to 6 quarters, but in the coming quarters, as these companies give more promotions, as the consumer kind of gets benefit of lower inflation, we believe that consumption sector should also revive.
Within financials, is there a favorite of yours, PSU or private?
I think bulk of our portfolio is still privates. Those are good compounding machines. One would have 1 or 2 PSUs named, but large part of the portfolio is still private sector banks.
And why is that so? Because PSUs have outperformed in the last couple of quarters.
Yeah, so I think our point is, look, PSUs outperformed because they were under-owned. The valuation gap was really huge. If you look at the earnings follow through, private sector banks have also given good earnings. And again, that ownership factor for PSU is being taken care of. And as we kind of go towards the mid-cycle, the credit cost benefits which we got from PSUs particularly are going to be much lower.
Now, one of the views which was coming in is that as we are coming to an end of a rate hike cycle. The focus may go back to some of the NBFCs. Do you agree with that? Do you see that now NBFCs may come back into the play as rate hikes gets reversed by the end of the year, or maybe pause and then reverse?
Okay, so we've seen that bit of a trade in NBFCs play out in last quarter or so. And look, as markets get excited about these pause and impending cuts, obviously this may continue for next couple of quarters. But medium term, our view is, look, inflation is going to be slightly sticky. You're not going to see a meaningful fall in rates, and that's where we prefer the banks who've got a good liability franchise over the NBFCs. And time and again, we've seen banks are more resilient. From a portfolio risk perspective, also, we're both happy to build that risk from a real estate exposure perspective, from an industrial exposure, or consumer discretionary over NBFCs.
And one sector which has been in focus is the energy sector, with oil prices, moving down and then OPEC stepping in some way. Do you see there's going to be some traction for the oil sector in the coming quarters?
Okay, so if you see, I think in the coming quarters, what we're going to see is significant refining capacity being added in China, and same happens for the petrochemical capacity. So spreads are going to be under pressure. We don't have direct an oil plays in India. The realizations are somewhere in a band or a cap, etc. So we broadly underweight that space. I think there are much better compounding stories in the country compared to oil and gas sector.
Can you give me some examples of the compounding stories that you're looking at?
I think something which we've liked in our portfolios and have worked is the hospital space. So I think what we've seen is, again, some of these names which we own is the likes of Narayan, Haridwar, Fortis, etc., or Apollo hospitals. They've done well over the last 3-4 years. Interesting stories would be, again, select few QSR names like Westlife, etc. And then again, there are interesting opportunities coming through these IPOs. So lot of good names are there, and I think which is where one would like to divert more in time and energy on these names compared to the energy sector.
Are you bullish on the forthcoming IPOs which are coming in today? Another third-party LED lighting company is coming out with an IPO opening today. Is there, you're seeing a new kind of newer age companies, newer companies coming into the market, and that gives you opportunity to expand your portfolio as well?
Absolutely. So some of these IPOs which we participated one of them was Dream Folks, etc., and that did well, and the company is in a unique space. A similar thing in the IPO you mentioned, IPO, where we have gone as anchor investors. So some of these are interesting opportunities, and look, even the best of the investors get 7 out of the 10 right. So again, our idea is we want to back good, competent managements in a space with huge headroom for growth, and build our exposure at reasonably attractive valuations. And the hope is the story plays out. But overall, to your point, look, we need to widen this whole opportunity set in India, and that's the advantage China had over India, the sheer breadth of companies across market cap sectors which was available. So these IPOs would give great exposures, and some of these companies which are coming are benefiting from China plus one strategy, this manufacturing boom which is happening in India, this export order momentum which is coming in favor of India and other EMs.
As a foreign investor, Rahul, are you seeing the opening of the primary markets again? Because we opened up, there was a valuation bubble which everyone spoke about. Then there was a steep correction. Then the primary market went for a pause. Now again, we're seeing sporadic IPOs coming in. Do you see valuation now much better, or the way IPOs are priced are much better or fairly priced for investors to look at it?
Yeah, clearly, I think the risk reward in IPOs which are coming in this round, provided one picks right business model, backs the right management, is lot better than what happened in the frenzy when we had some of these internet companies which were going public. Look, the managements are aware of the fact that you need to leave something on the table. Valuations have to be reasonable, because the delivery cannot be always perfect, cannot be 100% of what you laid out at the time of the IPO. So there would be always some gaps. At the same time, investors have been fairly discerning about the valuations they would pay. So I think the discipline has been fairly high from investor side, which is where a lot of these IPOs which have come in recent times have created value for people who participate.
Rahul, it was a pleasure talking to you today. Thank you very much for joining us from New York today on Talking Point. Thank you very much.
Thanks for having me.